When people first hear the number $100,000, it often sounds like a milestone rather than a turning point. It feels like a large amount of money simply because of how humans mentally categorize numbers. Yet the deeper reality is that this number often marks the point where the mechanics of money begin to change behavior inside a financial system. The difference is not psychological alone, it is mathematical. Imagine someone who has been saving consistently for years, slowly building their financial base through income, discipline, and time. In the early stages, progress tends to feel slow and almost invisible. Each month requires deliberate effort, and the increase in total wealth is driven almost entirely by the act of saving itself, rather than by the money already accumulated. In other words, the system is powered mostly by new input rather than by internal growth. At lower balances, money behaves in a very linear way. If someone saves $500 each month, their net worth rises almost exactly by that same $500 each month. The numbers move forward steadily, but they do not accelerate. Growth remains dependent on work, income, and personal restraint. This is the phase where many people feel that building wealth is simply a matter of effort. But something subtle begins to change as the base number grows larger. The shift is gradual enough that it often goes unnoticed at first, yet mathematically it becomes increasingly important. Once a financial base approaches six figures, the money itself begins contributing more meaningfully to the overall increase. Consider a simple example using long-term market averages. If a person holds $100,000 in diversified investments and the average annual return is 7%, the growth generated by the money alone becomes roughly $7,000 per year. Spread across 12 months, that represents about $580 per month produced by the existing capital. That number matters because it begins to resemble the amount many people are able to save from their income each month. For the first time, the financial system starts producing growth that can rival the effort of saving itself. The wealth is no longer moving forward only because of labor. The base begins to participate. This moment does not suddenly transform someone's financial life, and it does not guarantee stability or independence. Instead, it represents a structural shift in the way growth happens. The engine changes from a single force to a combined one. Savings continue pushing the system forward, but the accumulated capital begins adding momentum. Psychologically, this change can alter how people experience progress. Early saving often feels like pushing a heavy object across the ground, where every inch requires visible effort. Once the base grows larger, the movement becomes slightly easier to sustain because the system itself contributes energy. This is why many long-term investors describe the first $100,000 as the slowest stage of accumulation. The time required to reach that point can span many years, not because people are doing something wrong, but because the mathematics of compounding have not yet had enough scale to express themselves fully. Compounding is frequently described using dramatic examples that stretch across decades, yet its early stages are quiet and gradual. It begins almost invisibly, with small increases that barely register compared to the effort required to create them. Only when the base becomes sufficiently large does the pattern become more noticeable. Historically, this pattern appears repeatedly across different economic environments. Whether looking at retirement accounts, long-term index investing, or diversified portfolios, the same structural behavior emerges. Small bases grow primarily through contribution, while larger bases begin growing through interaction between contribution and internal expansion. Another important aspect of this threshold is how it changes financial risk perception. When a person has only a small savings buffer, every expense or disruption carries greater weight. The financial system around them feels fragile because the margin for error is narrow. Once a larger base exists, even modest growth can help absorb some of the unpredictability that comes with real life. This does not eliminate uncertainty, but it changes the structure of resilience. Money begins functioning not only as stored effort, but also as a stabilizing mechanism within a personal economic system. In many ways, the $100,000 threshold represents a transition between two phases of financial development. The first phase is accumulation driven almost entirely by behavior. The second phase gradually introduces mathematics as an additional driver of growth. Understanding this shift can reshape how people think about long-term financial progress. Instead of interpreting early slow growth as failure, it can be viewed as a natural stage of system building. Just as physical structures require a foundation before higher layers can be added, financial systems often require a certain base before compounding becomes visibly meaningful. The key insight is not that $100,000 holds magical properties, but that scale changes how systems behave. Small systems rely on external input, while larger systems begin generating their own internal movement. Once this dynamic becomes clear, the long arc of wealth accumulation starts to look less like a straight line and more like a gradual curve. Early progress may appear slow and uneven, yet the mathematics quietly prepares the conditions for future acceleration. And when people eventually look back at the moment that curve began bending upward, they often discovered that the turning point was not a sudden windfall or dramatic event. It was simply the point where the system became large enough for the rules of compounding to start revealing themselves.